Hello friends and welcome. Today we are going to talk price to EBITDA ratio. 4 key points for effective valuation. Before we jump into the video, make sure you like the video and subscribe to our channel for more educational videos. Now, let's get started. The price to earnings before interest, taxes, depreciation, and amortization P to EBITDA ratio is pivotal for investors evaluating a company's valuation relative to its earnings before non-cash expenses. Here are 4 key points for effective valuation analysis. Definition of P to EBITDA ratio. P to EBITDA ratio compares a company's market price per share to its earnings before interest, taxes, depreciation, and amortization per share, indicating the investor's willingness to pay for each dollar of EBITDA. Cash earnings measure. EBITDA serves as a measure of a company's cash earnings from core operations, excluding non-cash expenses, providing insights into operational profitability. Comprehensive valuation indicator. P to EBITDA ratio offers a comprehensive valuation indicator, especially beneficial for companies with significant depreciation and amortization expenses, facilitating better comparison across industries. Usefulness in capital-intensive industries. P to EBITDA ratio is particularly useful in capital-intensive industries where depreciation and amortization expenses are substantial, providing a clearer picture of operating performance and valuation. Conclusion: analyzing the P to EBITDA ratio involves understanding its definition, recognizing it as a cash earnings measure, its comprehensive valuation indication, and its utility in capital-intensive industries. Considering these points empowers investors to make more informed decisions regarding a company's valuation and investment potential. I hope that you like the video and do follow our channel for more professional and business tips and other interesting videos. Thank you and goodbye.